Hello and welcome back to Patrick Boyle on Finance, where we learn all about quantitative finance. Today we're going to be discussing what correlation is and why it matters to traders and investors. We'll learn why correlation is so high right now and why investors might care. Keep watching until the end of the video and I'll explain a trading strategy where traders can profit from rises and falls in stock market correlation. Okay, so here's an interesting statistic for you. Right now in June 2020, the S&P 500 index's 3-month realized correlation has settled around the 0.8 level, its highest in about 8 years. Even though other gauges of market stress such as the VIX index and even just the level of the S&P 500 have returned to normal levels or to at least unstressed levels, the divergence between these indicators suggests that investors continue to focus on just one main driver, and that is the global coronavirus pandemic. And that makes it harder for active fund managers to beat their benchmarks. Essentially what it means is that all stocks are either rising or falling together, and it doesn't really matter which ones you pick to invest in. Correlation is a statistical measure that indicates the extent to which two or more variables fluctuate together. It measures the degree to which two phenomena are related to one another. A positive correlation indicates the extent to which variables increase or decrease in parallel, and the negative correlation indicates the extent to which one increases as the other decreases. Uncorrelated variables have a covariance of 0, and so if two variables are uncorrelated, there's just no linear relationship between them. Correlation is one of the most useful statistics to a trader. This video, by the way, is based on my newest book, which is called Statistics for the Trading Floor, and it's being released in a day or two on Amazon.com. In fact, it might be released by the time this video goes up. There's a link to it in the description below if you're interested in taking a look at it. And actually, you can also check out my other books on derivatives and corporate finance if you're interested in that kind of thing. Okay, so the S&P 500 index's 3-month realized correlation began the year with a value of around 0.2. The gauge of how closely the top stocks in the S&P 500 move in relation to one another spiked to 0.85 in mid-March, which was the peak of the coronavirus sell-off, before steadying down at 0.8, where it is roughly right now. A maximum possible correlation is 1, which would signify that all stocks are moving in precise lockstep with one another. During periods of high correlation over the last decade, people have blamed either the rise of index funds or quantitative trading algorithms that rely on historical relationships and end up blindly reinforcing those correlations. A lot of investors, in particular fundamental investors, argued that something was broken in the pricing and capital allocation functions of the stock market, and that all of the different stocks simply rose and fell together, trading like they're one big stock. This time the argument is quite different. The current explanation for high correlations in the stock market is that in February there was an economy, and then in March the economy just shut down. And eventually there will either be an economy or there won't be. If there is an economy, then different companies will have different earnings. But if there's not, then no companies will have any earnings, right? And so obviously every company will be better off if there is an economy. And basically your bet on whether there will be an economy and when will almost certainly determine whether you think any particular company's stock is over or underpriced. Particular differences in the outlook for specific companies have become in this environment essentially irrelevant. This, of course, is an oversimplification. The S&P 500, as I mentioned, the correlation is 0.8, not 1.0. And certain companies that are holding up well in this environment are, of course, performing better than the most hard-hit sectors. But overall, this might be the correct rough model. If you're an active fund manager who spent the last few years arguing that index funds are fine in a rising market with high correlations, but in more complicated times, investors are going to need the human intuition of active fund management, this outcome is far from ideal. You were kind of hoping for the market to go back to what you call normal, with some stocks going up and others going down, so that you could pick the good ones that go up, while index funds were of course forced to not only pick those good ones, but also to hold the ones that go down as well. Instead, what's happened is the bull market broke in a way that ended up increasing correlations rather than decreasing them. In early 2020, all companies were overwhelmed by the same novel risk. They sold off altogether and then recovered altogether based upon global government intervention. One thing that sometimes confuses traders about correlation is that two assets can be highly correlated and stay that way, yet one asset might yield a positive, we'll say 50% return in a year, while the second asset could end up realizing a yield of minus 50% over the same period. At first that doesn't seem to make sense, but the reason for this confusion is that traders often misunderstand what correlation means and what it doesn't mean. Correlation is best thought of as representing the general directional relationship between two assets. If two assets start out with a price of, we'll say 20, and every time the first asset goes up by 1%, the second asset goes up by 5%, and that ratio of 5 to 1 is consistent, the correlation will be 1. It'll have perfect correlation, even though the second asset is producing 5 times the return of the first asset. In addition to this, there can be very high correlations between assets where one asset has a decay. So if we use the same example as before, and we say that the first asset lost 20 cents of value every day in addition to its relationship with the second asset, there can still be an extremely high correlation coefficient despite the first asset falling to 0 while the second asset rises in price. A common real-world example of this effect is levered ETFs, and I made a video about levered ETFs last week, which you might be interested in. The double short levered real estate ETF in 2008 was almost perfectly negatively correlated with the underlying real estate ETF, yet ended up losing almost half of its value. If you just shorted the real estate ETF rather than buying the double short ETF, you would have actually made money. So why does high correlation upset active fund managers? The idea is that when correlations are high, investors should spend more time worrying about the things that affect all stocks, things that affect the market in general, rather than worrying about the differences between particular stocks, which is usually what active fund managers focus on, in particular fundamental investment managers. When correlations are low, doing research to find the best stocks will be more valuable than when they are high, where having an accurate opinion on how quickly the economy will reopen is significantly more useful. So can traders trade correlation? In fact, they can. Correlation trading is kind of an advanced trading strategy in which the investor bets on the future realized correlation amongst the member stocks of a given stock market index. The goal in trading correlation is to predict when future realized correlation among the stocks of a particular index will be greater or less than the implied correlation level, which can be backed out from the pricing of options or other derivatives on the index and the stocks that make up the index. Due to the nature of diversification, the volatility of a portfolio of securities is pretty much always less than, or at least equal to, the average volatility of the individual securities that make up the portfolio. The lower the correlation is between the individual securities, the greater the diversification benefits will be, and thus the lower the overall portfolio volatility. What I mean by that is that when you've got a situation where some stocks are going up and some stocks are going down, you end up with dampened volatility because one is cancelling out the move of the other. But when they're all going together, you have the same volatility as if you just owned the single stocks. Thus, when expected correlation is really high, index volatility will be a lot lower than the volatility of the individual index members. And when expected correlation is very high, index volatility will be closer to the average volatility of the individual securities that make up the index. To sell correlation, a trader can either sell index options while buying a basket of options on the individual stocks that make up the index, or sell a variance swap on the index and buy variance swaps on the individual index constituents, or they can sell a correlation swap. To buy correlation, a trader would do the opposite of all of those things. So hit the like and subscribe buttons, and if you found this video useful, do check out my book, which is available on Amazon, and I've linked to it in the description below. Bye.